This incident happened a few years back, maybe around 5 6 years back. One day I was trading as usual in the market hours. One of my friends pinged me on WhatsApp and said he come across an interesting option strategy. He's experimenting with it and he said he has already made around 5 to 10% of the returns every month without much effort. But I was very doubtful and skeptical at the beginning, but I wanted to check his accounts. When I checked his account, it was true that he made around 8 to 10% of the returns every month for the last 6 months. So I checked with him what he is doing and all. I was surprised a lot when I came across the strategy he used. He used to sell both at the money call option and put option for Nifty at 9:20 a.m. and used to keep a stop loss of 2 times on both option. For example, if he sold Nifty 20,000 call option at 30, 20,000 put option at 30, just for an example, sake, okay, he used to keep a stop loss at 60 rupees for both option. If the stop loss hits on one side means he used to trial the stop loss of another leg to the entry price, that is 30, and hold for the rest of the day. So on sideways days, he used to collect the premium 30-30 for both the call option and put option. But if the market trends in one direction in a trending market, he used to lose money on one option, but he used to collect the same premium on the other option. Hence, the trade becomes break even when the market trends in one direction. Very, very rarely the market used to take the stop loss on both the sides. So I became very curious after learning this strategy and I started experimenting with it. So after few days or few weeks, the same strategy became very popular in India, called as 920 Straddle and 920 Strangle, and many traders started to take the similar trades with 0 DTE in different trading instruments. Recently, the popularity of these strategies has come down as most traders have started to implement the same. Hence, I feel the original edge is gone. But with a few modifications, we can still achieve the best results using these strategies. So we will discuss these small modification in detail in this video. So without wasting much time, let's start. Friends, in this video, I will be explaining 7 important steps to increase the success rate of short straddle or short strangle. But my request to you is don't believe these steps blindly. In fact, you can verify all these steps actually. There are many online tools are available to backtest the straddle or strangle. So my suggestion to you is take the essence of these 7 steps. You go back to those backtesting engines and test yourself. So once you test yourself, if you see the improvements in results, then only you can implement these steps. Maybe all of the steps or maybe some of the steps, maybe 1 step or 2 steps in your trading strategy, and then you start taking the trades. Okay. So the first step is instead of selling the call option put option at 9:20 a.m. you can push the timings. Instead of 9:20 you can sell at 9:30 or 9:45 or 10 o'clock up to 10:30 11. It is fine actually. Still there will be some premium at 9:30 9:45, even at 10 o'clock, even 10:30 11. So you can pick any one timing, maybe for example 10 o'clock or 10:15. Okay, then you can plan to execute the short straddle or short strangle. Instead of 9:20 you will shift the timings. See, for example, today is Tuesday 30th July, so it is Fin Nifty expiry. So what I do is I will go to Fin Nifty spot. CNX Finance is the Fin Nifty spot. See, at Fin Nifty spot, if I go to 5-minute chart today, if I go to 5-minute chart, see here the price was somewhere here, right? So if you have executed a short straddle, short strangle at 9:20, definitely you would have taken stop loss on both the sides, right? on these kind of days, it will hit the stop loss on both the sides when you execute at 920. For example, the same short straddle or short strangle, if you execute at 50-minute chart, for example, at 9:30, for example, this is the 50-minute chart of the same Fin Nifty. The market closed here because day started from here, so it closed here, right? See, if you execute here, for example, if you execute here, it would have taken the stop loss on call option side, but put option side you would have got the profit, right? Even if you execute at, for example, 10:15, you would have made money. So for example, I will take the example at 10:15. Let's say instead of 9:20, you decide to sell the call option, put option at 10:15. See, for example, at 10:15, 23,283 is the price. So the nearest at the money is 23,300. So let's see the strike prices for 23,300. See, Fin Nifty, 23,300 call option. So if you see the call option, probably in this case you would have sold at how much price? 60 closes 58. So you would have closed at 58.5. So you will keep the stop loss at maybe 110, 116 rupees. 2 times means 116 rupees. So this case it would have taken the stop loss, right? But if you go to the put option, Fin Nifty 23,300 put option, at 10:15 the price is somewhere 75.4. See, so in this case this is already came down to 10 rupees actually. So at this point of time, if you sell at 75.4, so you will keep a stop loss at 150 rupees. Now anyway, after this price has not gone up, so it came down, right? Now even the stop loss for call option might have hit, but stop loss for put option is still intact. Now there is a high possibility this will become zero, right? So call option, you lost profit at 58.5 points. In this case, you are getting a point of already you are in profit actually, because you sold at 75. You are already in a profit of maybe 5 to 7 points. But if it goes further down, you will make little profit, even though it moved directionally today, you would have made little profit, right? But if you would have followed at 920 short straddle or short strangle, you would have lost money because it would have hit the stop loss on both the sides. But if you execute the same straddle at different timings, maybe at 9:30, maybe 10 to 10:15 is the best timings, you will have the juice and you will make even some profit even on some directional moves like this. So anyway, you will make money on sideways days, but definitely sometimes you make money even on directional moves like today because of the premium difference. So this is the first step. This is the first suggestion to improvise the short straddle. The second suggestion to improvise the short straddle is, instead of 0 DTE, you can shift to 1 DTE. See friends, in a weekly expiry, the premium will, the DK will be high on the expiry day. Definitely there is no doubt about it. But the same DK will be, it is high compared to the initial days, even one day before. See, for example, today is the premium DK. It happens very rapidly on the expiry day, but one day before the expiry day also the DK will be very, very high. See, for example, if I go to the Fin Nifty spot, so this is the Fin Nifty spot. So yesterday what happened was there was a downside move, right? See, on downside move, so this example is little tricky because market moved very rapidly and you may not be able to experience or observe the DK at this point of time. But definitely one day before also there will be premium DK. So that is, instead of 0 DTE, you will take the advantage of 1 DTE. Definitely, you may not be able to make that much of profit 0 DTE compared to 1 DTE, but definitely there will be a DK. And the biggest advantage of following 1 DTE is you can avoid the spike issue. In the recent times, if you would have noticed, right, there are many spikes which will it will skip your stop loss order and you will experience a big loss. So if you when you follow 1 DTE, you can easily avoid those kind of issues, because as far as I know, as I remember, these spikes issues occurred only on 0 DTE cases. So whenever you follow 1 DTE, you will avoid at least 80 to 90% of those spikes. So this is another way of improvising the short straddle or short strangle. In addition, it acts like an insurance, right? Because you easily avoid the spikes issues. So it gives extra cushion to your trading account. So this is the second suggestion. And the third suggestion is you can use any indicator and identify the sideways market in that indicator. Then only you can execute your short straddle or short strangle position. See, for example, I will remove this. I will go to Nifty. I will remove the lines for the explanation sake. For example, one of my favorite indicator is RSI. So you can plot the relative RSI indicator, and probably if you don't know the technicalities of RSI indicator, I will explain in a quick manner. See, RSI, don't go with a traditional definition. Plot RSI for 60 and 40. See, whenever the RSI is above 60, so this indicates bullish market, and whenever the RSI is below 40, so this indicates the bearish market. Okay. So whenever the RSI is in between 140 and 60, so this indicates the sideways market. Don't go with the traditional definition of 70 or 30. You can change the settings to 60 and 40. So you can plan to execute your short straddle or short strangle whenever the RSI falls between the range of 40 and 60. So I will plot it on charts and I will explain. Time behaving, I will remove this. See, I will change the settings to 40 and 60. So by default it will have 70 and 30. So I will remove everything. I will remove the Bollinger Band. I will remove the regular bullish, bearish. I will remove all these things. I will remove the middle band as well. So upper band I will make it 60. Lower band I will make it 40. So this fill, okay, Bollinger Band fill is not needed. No, all these things are not needed. Now I will, time being, MA, let it be there. Okay. So now you can see whenever the market trend, see from here the market, it is like a breakout started, right? Suppose if you draw a trend line like this, okay. So somewhere here the breakout started, right? The breakout started and market started going up. See here at the same point of time, RSI moved above 60. So whenever the RSI stays above 60, you can easily confirm the market is in uptrend. Similarly, whenever the RSI stays below 40, it indicates downtrend. See here also the RSI started going up, the breakout started, the upside movement started. So whenever the RSI stays below 40, you can consider this is in a downtrend. So till here it is a downtrend, small, even though it is small. See here, it is the RSI stayed below 40. In this case, it is in a downtrend, isn't it? So the same logic applies to intraday trading as well. But whenever we get into intraday trading, there is a problem with RSI. I will explain. See, for example, this is a 50-minute chart, and what happens is, the RSI value goes below 40 or above 60 and it comes back immediately. There will be kind of false movement actually. See, for example, anyway, this is very clear from here. It's gone up, it stayed upside. Here you can see there is a small fake move, right? So if you have sold short straddle, anyway you don't sell the short straddle in the first candle, but by any chance just assume it came in the in between, and if you sold short straddle, there is a false scenario, right? I will look for a better scenario. For example, in this case, see here RSI went above 60, here also, it went up quickly and it came down, right? See, if you have exited your short straddle, short strangle, here also, see here also. So the best way to avoid these kind of false indication is by following RSI based MA instead of RSI. So you can get rid of RSI, you can plot RSI based MA. So for the moving average, you can keep the length of 3 or 5. 3 is more than enough. If you plot this, you can increase the brightness because it is not visible. So you can plot block, you can increase the thickness. You can see here. See now, let's say you can execute short straddle, short strangle whenever the RSI is in between and 40 and 60. See today in this case Nifty is anyway, it's below 40 and 60. You can execute the short straddle. And on a trending market, see for example on this day, the market started trending, right? See after 9:30, for example, if the RSI stays above 60, you don't have to execute the short straddle or short strangle. So if it comes back 60 and if it closes below 60, then only you can plan to execute it. See in this case, you would have avoided a loss, right? See here after 9:15, the RSI stays above 40 and 60 here, right? So you can easily execute the short straddle, short strangle at 9:30. Anyway, you would have made profit because by this time, if it is 0 DTA, 1 DTA, you would have collected the premium, right? If it is 0 DTA, definitely would have collected all the premium actually on this particular day. So here also it's stayed in between 40 and 60, you would have collected all the premium, right? If it is 0 DTE. So in this case, the market is volatile, it is fine. So in this case, see here, would have not initiated, short straddle trade because RSI is below 40, right? See, whenever it entered the 40-60 range here, you would have initiated a short straddle and you would have made profit, right? If you followed 0 DTE or even 1 DTE. Again, the same logic. On this particular candle, you won't execute the short straddle, short strangle. Whenever the RSI entered 60, below 60, in this case, in this candle, third candle. So you would have made slight profit, right? So in this way, you can use any indicator. The best indicator is RSI, but you can use any other indicator which highlights the market is in sideways. Okay, you can use Bollinger Band, or you can use ADX indicator. So anything like that. Now I can explain ADX indicator as well. In ADX, what happens is I will close the RSI indicator. If I plot ADX and DI, you can pick this ADX and DI. So in ADX indicator, how it works is whenever the ADX line is above 20, it indicates strong trend actually. I will increase the ADX line. Instead of, I will go for line. Okay. So I will increase the thickness. Okay. Okay. So whenever the ADX line is above 20, this line I need to increase. This is fine. I wanted to increase the thickness of this ADX line. Level, I will keep it dashed line. Okay, now this is clear. See, whenever the ADX line is below 20, below this 20 reference level, you can initiate the short straddle or short strangle, because in ADX line above 20, it indicates a strong trend. If the green line is above red line, that indicates a bullish trend. If the red line is above green line, it indicates a bearish trend. So for short straddle, short strangle, this anyway it doesn't matter. It indicates all you need is the strength of a trend. So whenever the ADX line, this ADX line, black color, dark blue color ADX line is below 20, it indicates the sign of a weak trend actually. So if you look at Fin Nifty, definitely it is little high, I guess. If you look at Fin Nifty, see here it is above 20. Okay, so now it is the right time because it is coming below 20. You can execute the short straddle or short strangle whenever the ADX line is below 20 actually. See here, if you go back, even if you go back, so see here, it fell below 20. ADX line fell below 20 in this candle. This is the best time to enter your short straddle, short strangle. If it is a 0 DTE day, you would have made profit because price completely went into sideways, right? So this is how one can use any indicator to execute or to start the short straddle or short strangle trade. The fourth approach is using the balance approach, balance market scenario. So most probably people, they don't know what is the balance market or imbalance market. So I'll explain both the imbalance market and balance market, then you can take a call. See, probably you don't know this is probably most people don't understand this at the beginning, but anyway I'll explain in detail. See, for example, let's assume this is the previous day high and this is the previous day low. Do you know what this indicates? So what this previous day high indicates is, so this is the price level on which on yesterday there was a last buyer, or the big selling started from this level, right? So last buyer were at this level. Similarly, on previous day low, last selling point on this price level, there was the last selling point, and buying, strong buying started from this level. At least you know this point, you can understand this point, right? Now, if uh, many people think that market operates only in between 9:15 a.m. to 3:30 p.m., but that is not the case. Market will be running in people mind forever. Even when they are sleeping, they will be thinking about the market, right? So if they have some position, if there is a news, they think that it is going to affect, and they will take the counter position, or they will close the position, or they will do something whenever the market opens on the next day. Let's assume this is the previous day high, this is the previous day low. Market opened exactly at the center range of the previous day range, and it didn't move anywhere upside or downside. So let's assume at 9:15 it opened at the exactly center part of the range. Either it didn't go upside or it didn't go downside. It displayed a small candle exactly at the previous day range, exactly at the center part of the previous day range. So what this indicates is, it indicates a balanced market condition, which means there is a high possibility of price staying within the previous day range. So whenever you see a balanced market scenario, you can automatically you can deploy short straddle or short strangle. So this is one way. And in imbalance market scenario, see, suppose this is the previous day high, this is the previous day low. Let's assume there is a positive news to the market. So in such situation, what happens is market opens with a big gap and it closes on the upside. So whenever you see an imbalance market condition, there is a high possibility of price going in the direction of the imbalance market. So in such scenario, it doesn't make sense to execute the short straddle or short strangle. Okay, see here also, suppose if the price opens downside, let's say there is some bearish news towards the market, hence the price opened and displays an imbalance market. Even in this case, there is a high possibility of market going in the direction of the imbalance market. So whenever you see an imbalance market, you can avoid the short straddle or short strangle. And whenever you see the balance market, you can execute the short straddle, short strangle. This is one way of improvising the short straddle and short strangle. See, for example, what I do is I will go to Nifty and I will check the results. See, for example, if I go to Nifty, see, this is the range actually. Okay. See, in this case today, for example, this is the previous day low, this is the previous day high. Nifty displayed a kind of balance approach, right? So there is a high possibility of price staying within the previous day range. So this is the best time to approach or execute the short straddle or short strangle. So in this case, see, this is the perfect scenario I explained. See, this is the, what I do is I will move like this so that you will understand it in a better way. See, this is the previous day high and this is the previous day low, right? See, market opened and displaced an imbalanced market scenario, right? So what this indicates is there is something, okay? If there is a balanced approach, market would have opened here. So in this case, there is an imbalanced market, hence price opened and opened above previous day high and closed above previous day high, and it clearly indicates buyers are really strong. So this indicates a imbalanced market in the upside direction. So there is a high possibility of price going on the upside itself. So whenever you see an imbalanced market scenario, you can avoid the short execution of short straddle or short strangle. By any chance, if the price comes back and closes within the previous range, then you can execute the short straddle or short strangle. So now in this particular day, it didn't came back, right? Then you don't have to execute the short straddle or short strangle. I will go little backside to pick certain example. This is an extreme scenario you can always avoid. See, in this case, it appear like an imbalanced market, but it closed below the previous day range. Anyway, in this situation, you can execute the short straddle. Anyway, the stop loss for put option would have hit, but you would have made money with a call option. So maybe it is either a break-even trade or a small loss trade or a small profitable trade. So even in this case, see here it is a doji within the previous day range. It is a kind of balanced market, so you would have made profit, assuming this falls under 0 DTE. So the same scenario here. See, this indicates an imbalanced market, right? Because price closed above the previous day high. So if you would have executed the short straddle, you would have taken stop loss on both the directions actually. You would have lost money, right? So in this way, using the balance approach, balance market or imbalance market, you can improve the returns of short straddle or short strangle. Now, the fifth option is to check the volatility. See friends, whenever you see, India VIX, for example, if I go to India VIX, let's say if the India VIX is increasing when you plan to take the short straddle or short strangle, then it is not a good thing. See, for example, yesterday India VIX increased, right? So whenever the India VIX is increasing, it is not a good idea to execute the short straddle or short strangle, because whenever the volatility increases, the premium automatically increases. Suppose if the underlying instrument also moves, means definitely there is a high possibility of hitting the stop loss. So you always look for the opposite scenario. See here, the India VIX decreased, right? So whenever the India VIX is decreased, you can plan to take the trade. For example, this is on Friday, 26th July. You can see what happened on that particular day. Nifty, if you go to Nifty, so in this case, it went upside actually. It is a little bit tricky. If you go to Thursday, see for example, Thursday, I'll just confirm it is Thursday, 25th July. Thursday, 25th July, volatility sideways. This is an exception day, it's okay. So but my point is very simple. If the India VIX is really increasing, you can think about it, okay? So you can plan to take the short straddle, short strangle whenever the VIX is reducing, whenever the volatility or IV is reducing. That is the best point actually. And sixth point to improve the short straddle or short strangle is exit. I have seen many traders, they hold their short straddle or short strangle position even when the premium is 0.5 paisa or 1 rupee or 1.5 paisa, even after 230. It is not really needed, right friends? See, for example, today, if I go to FinNifty, okay, so FinNifty is somewhere trading at this level. See, let's assume you sold 23,300 call option, 23,000 put option. Just check 23,300 put option now. 23,300 put option. Okay. See, 23,300 put option is now trading at 12 rupees, 11 rupees. If it, by 1 o'clock, 2 o'clock, it will there is a high possibility of it will come down to 1 rupee or 1.5 rupees. See, you don't have to hold that trade after a certain point, right? See, because most of the time these spikes or the sudden moves comes, or the volatile move comes after 2:30 p.m. Suppose if the premium already reduced to less than 1 rupee or 0.5 rupees by 2 or 2:30 p.m., you can close the trade, right? There is no meaning of carrying the position. If it is less than 1 rupee, you can take a call. Let's say you would have sold the premium, you would have sold the position at 12 rupee or 20 rupee or even 25 rupee or even 15 rupee. If it comes less than 1 rupee, you can always close the position, right? You don't have to carry the position. When the premium is 0.5, 0.75 or 1 rupee, you can close the trade. If you're a really conservative trader, if you want to avoid the volatile moves, it is always better to exit the position. Suppose, let's say you have taken you have sold both the call option and put option, both are running parallelly, it didn't hit the stop loss on any direction. Now the premium is 4 rupee, 5 rupees on both the cases. If the time is 2 o'clock, so you can always exit. You would have made the profit, right? Correct, right? So volatile moves comes after 2:30 p.m. usually on the expiry day. So you don't have to hold the trade after 2:30. You can always exit before 2:30, or you can always exit if the premium falls below 1 rupee, right? So in this way, you can always improve the performance of the short straddle or short strangle. But as I said earlier in the beginning, you should always backtest. You always backtest of any particular rule. You make a rule, you backtest it, implement it only if you see the positive results. Okay. Now the seventh option. So the seventh option is always avoid taking the short straddle or short strangle on the event day. Okay. I know this is a debatable statement, because whenever I say, people will shout back and they say, Indra, on event day IV will come down, definitely the premium decay will happen, etc., etc. I do agree, friends, but if something goes wrong, automatically there is a high possibility of IV shoots up, right? One day prior to the event day, it is fine, because there will be IV shoots up, IV will come down. But on the event day, for example, budget day or expiry day, I mean not expiry day, the budget day or the Fed rate announcement day or RBI quarterly rate changes day. So all these days you can always avoid, because sometimes in case of a positive news or negative news, the IV spikes up actually. That is one thing. That is not the only problem. The another problem I have noticed on these days is, price moves on both the direction, right? So this hits the stop loss on both the sides. First it hits the stop loss on put option side, then it will hit the stop loss of call option side, then you end up making the losses on both the sides. So this automatically brings a bigger loss. Actually, you end up losing 2% or 3% of your entire capital actually. So on these kind of days. So if you just avoid these kind of days, automatically on the remaining days you will be profitable, right? So whenever you avoid a big loss, you always become profitable actually, because whenever you take a trade, there is always a possibility of 5 outcome, right? You can make a big profit, you can make a small profit, you can make a break-even trade, you can make a small loss, you can make a big loss actually. So whenever you avoid big loss scenario, so the remaining days you make either a small loss, break-even, or small profit or big profit. So the aggregation, the average of these four, you always end up making a profit, right? So that is why I always suggest to avoid execution of short straddle or short strangle on event days. Okay. Friends, I hope this video really added value to your time. If yes, you can share this video with your friends, you can like the content, you can subscribe to my channel. Anyway, I will come back to you in the next video with another useful content. Thank you. See you. Bye bye.